Okay, and welcome back, students who are taking financial accounting. This is chapter 2, working on the short exercises. And like I alluded to in the previous video, I'm not going to be repeating myself with things like, watch this again if you don't understand it, and contact an instructor. So I'm going to try to think through so that I'm keeping the time limit on these videos down to a shorter time limit. But realize if you do have a question, feel free to contact an instructor. So let's pick up where we left off at 2-7. Right, so it says here, calculate each account balance. So notice that we have T accounts here, okay? And in the theory videos, we had one video that discussed T accounts itself. Notice that these are, great big T, okay? So with the T account, what's on the left is a debit, and what's on the right is a credit, okay? So if we're going to calculate each balance, we add up our debits and we add up our credits. And then we subtract one from the other, and whichever is greater, that's the side it goes on. So the total of our debits here is 250 plus 800, which means that's 1,000 on the debit side. And on the credit side, we have 400. So the difference between those two is $600. And since the debit is greater, the balance goes on the debit side for $600. For the note payable, on the debit side, we have 1,250 plus 4,500 is 5,750. And of course, on the credit side, we only have 9,500. So the difference between those two is 3,750, right? And since our credit side is greater, we put the 3,750 on the credit side, okay? And the thing that to know, to be of note, remember when we're talking about the normal balance of an account, right? We're talking about what increases that account. So when you're looking at an account like supplies, okay, if you have a balance in the account because supply is an asset and we increase the assets on the debit side, most often, I'm not saying all of the time, but most often the balance in that account is going to be a debit. Just like for a note payable, which is a liability account, most often the balance in that account is going to be a credit. Why? Because that's the normal balance of a liability account. Think about it this way. If we had a notes payable and originally we owed $9,500 and we made a payment and then we made a second payment, right? And so now we still have a remaining balance of $3,750, right? Well, if we made another payment for $3,750, okay, then our balance in the account is going to be zero, right? The balance in the account is going to be zero on the credit side, right? So we usually don't go below zero, okay? And by having a debit or a credit as our normal balance, that allows us to work with positive numbers all the time. Just a matter of which side you put it on the debit side or the credit side, because generally you don't go below zero. Now, don't misunderstand me. I mean, there are exceptions to the rule. For example, you can have your cash account. Well, if you become overdrawn, now remember, a debit, cash account is a debit as the normal balance. If you become overdrawn, now you're into credit territory. Okay, and the same thing with account called cash over and short, right? You use only one account, and depending upon whether you have too much overage or too much of a shortage, if you have a shortage, you're going to be dealing with a negative number, right? So just realize that you want to be most often the category of account, all right? Um, I'm sorry, the account itself, whatever its normal balance is, you're going to have, if you have a balance in the account, it's going to be that side, the debit or credit side, whatever is the normal balance, all right? Um, the reason why I bring this up is because some students might do this math and they might put 3750 on the debit side because they think there's more than one transaction there and that's the side it belongs on, which is um, they're not thinking through the entire process there. They're not, they did the math, but they're not thinking, well, okay, it should be on the credit side just because they see a whole bunch more transactions. Here, you have a tendency to think, oh, there's a lot of numbers, so that's the side you put it on. No, that's not the case. Okay, so that's 3750 there. Okay, 2-8. Complete the following table for each account listed. Identify the type of account, how the account has increased debit or credit, so that's the normal balance, and how the account is decreased. All right, use the most detailed account type appropriate. Okay, so as an example, office equipment, that is an asset because it's something we own. And we know that we increase assets on the debit side. So this is representing the increase, and this is representing the decrease. Okay, well, because it's an asset, we know we debit the asset. We increase the asset on the debit side. Dividends is stockholders' equity. Okay, and with equity, we know that we increase the equity on the credit side, which means the opposite is a decrease on the debit side. Now, the thought just occurred to me, by going through these exercises, it's almost like getting you to memorize these things, okay? Because you saw me in, previous videos, write out assets equal liabilities plus equity, and I had revenues less expenses, gave me a profit or loss, and I had drew this is what I had written out, debits, credits. So the normal balance of an asset is a debit, the normal balance of a liability and equity is a credit, revenues it's a credit, and expenses it's a debit. Okay, this is the visual aid, but notice I use this visual aid and I talk through the relationship. Here they're basic, by doing these exercises in the textbook, it's almost like trying to get you to memorize it, right? But don't memorize, think through. Revenues are a revenue account. Well, we increase our revenues on the credit side. The opposite means we have to decrease it on the debit side. Payables is a liability, right? So we increase that on the credit side. The opposite means we'd have to debit it to decrease it. Rent expense, that's an expense account, and we're increasing that on the debit side, decreasing it on the credit side. Cash is an asset, increase that on the debit side, decrease it on the credit side. Now, notice that, I went and said, oh, okay, like the asset, increase it on the debit side. Well, obviously the opposite of an increase is a decrease, so the opposite of a debit is a credit. I don't have to memorize it. I can just think it through, okay? And again, you will come across accounts that you're not going to know that well, and you're going to have to think, what category of account is it? And when you figure out the category of account, then you're going to have to think whether the increase is a debit or a credit. If you try to memorize these, okay, yeah, you can memorize this table, okay, and you can keep on memorizing these accounts as they're being presented in the book, but you're going to come across accounts that you've never seen before, and they're not in the book, and then you're dead in the water because you're trying to memorize them. So think through the process. I know I keep on harping on that, but accounting is about understanding an application, not memorization. Okay? 2-9. Recreating journal entries from T account postings. Let's see here. Haskins Inc. began operations on January 1st, 2014. The 7 transactions recorded during January by the company are shown in the following T accounts. Okay, these are T accounts. Now remember, they're using the T account as a tool, right? So they're looking at the cash account, the GL account called cash, and they're using the T account to show the transactions in those accounts. And notice that you have numbers here, okay? Now you don't normally write these numbers in, but when you have a bunch of accounts like this, you use these numbers to identify the journal entry, that particular transaction. So when you're looking at number 1 here, you have to look through, and equipment has a 2, dividends has a 7, revenue has a 4, payables a 3 and a 5, here receivable a 4, okay, common stock is a 1 right here. Operating expenses has a 6 and supplies has a 3. So what you know is that by looking at these numbers, you're able to say, okay, I have a number 1 in cash, so I have a cash, and that's a debit, all right, for $15,000. So when I look for the other number 1, well, oh, that's in common stock, and that amount is for $15,000, and I see that's a credit, right, because it's on the credit side. So when you're looking at these accounts, you're looking in order to determine the journal entries, you are looking at the numbers to try to find all of the numbers that apply to that particular journal entry, because each journal entry is going to be numbered individually. Okay, and if you're looking at the numbers, and let's say you actually should have 3 lines as part of your journal entry, your debits must equal your credits. And if they don't, that means you haven't picked up some of that information when you're looking at this. Okay, so you saw me create the entry right here. Okay, but now it says down here, complete the table for each transaction shown. Determine the accounts affected, the type of account, whether the account increases or decreases, and whether it would be recorded in the journal on the debit or credit side. Okay, so what you saw me do by looking at the, finding the number 1s here, I was able to determine that, cash is debited for $15,000 and common stock is credited for $15,000, and that's what this transaction is showing. Number 1 shows cash and common stock, and we're seeing that I'm debiting and I'm crediting, I'm debiting cash and I'm crediting common stock. Now the rest of this problem is saying, well, cash is an asset and common stock is equity, and we see that we're increasing our asset and we're increasing our equity. So even though I made the journal entry up here, I need to actually put in, the cash being an asset and the stock being an equity, and showing that they're both increasing, which makes sense because, I'm giving the company $15,000 in cash, so whatever its balance was before, I'm increasing it $15,000 more. And my stock, whatever the balance of my stock was, I'm increasing that $15,000 more. Okay, so it's an increase. So that's what they're asking you to do in this particular exercise. And they gave you the example. So I have a separate, I'm going to work through each one and write the entry, and then when I'm finished, I am going to erase the entry. All right, so I'm not going to have a list of them like you would as part of the solutions. Okay, I'm just going to hit each and every entry in and of itself. All right, so they showed number 1, so now I'm going to look for the number 2s for my second entry. So I have a number 2 for equipment, so that's a debit to equipment for $3,000. Okay, and I'm looking for the other number 2 here. Number 2, where is it? Right here for cash. Okay, so I have a credit, it's on to cash for $3,000. Okay, now when I'm making this journal entry, notice that I'm indenting the credit here. Okay, I don't align it straight up and down, I indent it. And also notice that I'm using 2 columns. Okay, the left-hand column is a debit and the right-hand column is a credit. Your journal entry is wrong if you align them up, one right under each other. That's wrong. You can't determine whether it's a debit or credit from that. You need to show it as being offset into 2 separate columns. Okay, so that's the journal entry. And to finish it out, equipment is something we own, so that's an asset. And cash is something we own, that's an asset. And of course, the equipment, if we had some amount before and now we bought the equipment, we're increasing our equipment by $3,000. So that is, an increase. Okay, but in our cash, we're decreasing our cash because we're paying for the equipment. Okay, so that is the second journal entry. All right. Okay, so I'm erasing it. Pause the video and copy it if you have to. Number 3, the third entry, so let's see here, 274, 3 to accounts payable, and 3 to supplies. Okay. Remember, our journal entries always begin with our debits. So I have a debit to supplies for $600. And I have a credit to accounts payable for $600. So that's my journal entry. And of course, supplies is an asset because we own it, and accounts payable is a liability because it's something we owe. And we're increasing our supplies, right? And we're also increasing our accounts payable, right? Why? Because before, we owed a certain amount, and now when we bought the supplies, now we owe $600 more. So that's an increase. And remember, for liabilities, we increase it on the credit side. Okay, so that's number 3. Okay, 4. Okay, there's a 4 for receivable and 4 for revenue. Okay, so a debit to accounts receivable for $4,500 and a credit to service revenue for $4,500. Okay. Accounts receivable is an asset, and we're increasing the accounts receivable because we sold something and they owe us, so we're increasing what is owed to us. And our revenue is a revenue account, and of course that's increasing because I just made an additional sale. Okay, that's 4. 5. 5. Okay, and accounts payable and cash. Okay, so debits come first. Okay, and it's an accounts payable. Debit to accounts payable for the amount of $600. Okay, and we're crediting our cash, right, for $600. So what are we doing here? We're paying down our accounts payable. Okay, accounts payable is a liability and cash is an asset. But our accounts payable, remember, we increase on the credit side, right? That's the normal balance of a liability, all right? It's a credit, okay? So if we're debiting it, that means we're decreasing it. So the liability, we're paying it down. Before we owed $600. Oops, I did that wrong. It's not 600, it's 250. Okay. Before we owed 600, but now we're paying down $250 of it, so now we only owe 350. Okay, and you can tell that by the balance. There was our entry from number 3 when we bought these supplies on account, and now we're paying it down 250. So our balance, subtract one from the other, and since the credit's greater, it's on the credit side. Our balance now is 350 in the accounts payable. So we know that works. And of course, our cash, we're paying out our cash. So that's a decrease also. Okay. See, that was number 5. Number 6. 6, credit to cash there. And I'm looking for the number 6, operating expense. Okay, so I have a debit to operating expense for $2,300, and I have a credit to cash for $2,300. Notice I indented the credit here. Okay. So operating expense is an expense account. That's the category expense, and cash is an asset. Well, we know that our cash is decreasing because I'm paying it out for the expense, and if my expense was some number before and I'm incurring an additional 2,300, that means I'm increasing it. Okay, so I'm increasing the expense account, and notice our normal balance of an expense account is a debit. All right, so that's telling us to increase it. Right, and number 7 here. Let's see, number 7. Find the number 7. There we go. Okay, so I have a debit to dividends for 1,000 and a credit to cash for 1,000. Okay, so dividends is stockholders' equity, and cash is an asset. And of course, since whenever we're paying dividends, we're paying out cash. We're turning on the investment to the stockholders. So cash ends up decreasing, and of course, our dividend increases because we're paying it out. All right, we're giving a dividend. Okay, so with that said, I'm going to stop here and pick up with the next problem in the next video. Okay.